Hey everyone, let's look at the chapter on businesses and cost of production. The first concept we have is of economic cost. Economic cost is the payment that must be made to obtain and retain the services of a resource, as for example, land, labor, capital, or any other natural resources. Economic cost includes the explicit cost and implicit costs. Explicit costs are the out-of-pocket expenses that has to be made when we do a business, we start our own business. As for example, we have to pay for rent, the wages, the office supplies, and other miscellaneous expenses. That means these are the expenses that we can see and feel. Now, implicit costs are something which we cannot really see. These are not direct out-of-pocket costs. This is the opportunity cost of using self-owned resources. This includes foregone interest, rent, wages, and entrepreneurial income, which is also called normal profit. And as you can see here, the accounting cost includes only explicit cost, but economic, this one includes the explicit costs. With that, we have the implicit costs of production. So when we calculate economic cost and accounting cost, which we are going to do after the next two slides, we would see the value of accounting cost is always less than the value of economic cost, because accounting do not really include these implicit costs. Now we look at the concept of accounting profit and economic profit. Regardless of the size or structure, each firm has a motive, and the motive is profit maximization. And there are two ways we can define a profit. We can look at accounting profit and we can look at economic profit. So accounting profit is total revenue minus explicit costs. Revenue is price times quantity. From that, we just take off this out-of-pocket expenses. Now, economic profit is total revenue minus economic costs. So this economic costs, this includes both explicit plus implicit cost of production. The way they're writing this is because revenue minus explicit cost, this is accounting profit. From that, we take off the implicit costs of production. Okay. All right, over here, we are just expressing everything using these boxes. These economic costs are implicit costs and explicit costs. And this economic profit is total revenue. From that, we take off implicit and explicit cost of production. Okay. Now let's look at this worked out example where we are. I'm just going to read out this example here. It says, Fred currently works for a corporate law firm. Okay. Just to remind you, the source is from Open Economic Resources, which is free to all. All right, let's circle back to the problem. It says he is considering opening his own legal practice where he expects to earn $200,000 per year once he establishes himself. This $200,000, this is the expected total revenue. Now, to run his own firm, he would need an office and a law clerk. So these are the out-of-pocket expenses and these are explicit cost. I'll just write an E next to the explicit cost. He has found the perfect office, good for himself, which rents for $50,000 per year. He could hire a law clerk for $35,000 per year. If these figures are accurate, would Fred's legal practice be profitable? So we are adding up this to the office rental and law clerk's salary. These are out of pocket costs. These are the monetary outlays which are defined as the total explicit costs. So my total explicit costs from plugging in the numbers is $85,000. Now I want to find out the accounting profit, which is the total revenues. From that we take off explicit costs. So this is the total revenue, which is $200,000 here. From that I will take out this value, which is the explicit cost of production, and I have an accounting profit which is $115,000, and this looks like a good deal. This is definitely positive. And just if you look at the accounting profit here, I would say he should open this business. But let's look at something else here. Let's see what's going on in the next step. All right. It says, however, consider these calculations, consider only the explicit costs. Okay, that makes sense. However, these calculations consider only the explicit cost. We took care of that. To open his practice, Fred would have to quit his current job where he is earning an annual salary of $125,000. So this is implicit cost, and I would say this is an example of foregone wages. This is implicit cost. Then we have the explicit cost, which is $85,000, and then we have the total revenue, which is this one. Sorry about that, I should have circled this with this ink. And now this 85,000 and 125,000 here. Just gonna write here 125,000. This is the implicit cost. Then from step 1 we have the explicit cost, which is $85,000. If we do the math here, we have $210,000. So this explicit and implicit, this becomes part of the economic costs of production. So to calculate the economic profit, we have to take off the economic cost from total revenue, or rather the explicit and implicit costs. looks like the economic profit is negative $10,000. We can compare this with the accounting profits. The accounting profit is greater than the economic profit. This makes sense because the economic cost, which is 210,000, is much greater than the accounting cost, which is 85,000. So the accounting cost is only the explicit cost and the economic cost is both explicit and implicit. Now, if Fred opens up this farm, he would lose $10,000 per year. So my advice to him is just stick to your own job and do not open up your own farm. Alrighty, so when I'm calculating profit, I would like to look at economic profit and just not leave at accounting profit. That's all about explicit cost, implicit cost, economic profit, and accounting profit. Hope this makes sense.